Good morning, everyone. Today I'm going to talk about regulatory framework and risk governance. Regulatory framework and risk governance are essential part of the financial system. A regulatory framework refers to legal structure created by authorities to supervise and control financial institutions. It ensures that banks and other financial organizations operate responsibly. Risk governance refers to how institutions internally manage and oversee the risk through policies, procedure, and management structure. This topic is important because financial institutions deal with large amount of public money. Proper regulation help protect customers and investors, ensure the stability of the financial system, and reduces the chance of financial failure, frauds, and economic crisis. Key concept. There are several important components in regulatory framework and risk governance. First, regulatory authorities such as Reserve Bank of India play a key role in supervising financial institutions and setting standards. Second, institutions must identify different types of risks such as credit risk, market risk, and operational risk. After identifying risk, institutions measure and monitor them regularly. They also implement internal control to reduce risk exposure. Finally, banks and financial institutions must submit regular reports to the regulators to ensure transparency and compliance with the rules. This creates a continuous cycle of regulation, risk management, and supervision. Working. The process begins with when regulator establish rules and minimum safety requirement for the financial institution. Banks then analyze their operations to identify possible risk and take steps to manage those risks effectively. This include maintaining sufficient capital, improving internal control, and monitoring financial activities. One important measure is use of capital adequacy ratio, which shows whether a bank has enough capital to absorb potential losses. For example, if a bank has rupees 200 crore in capital and rupees 1000 crore in weighted risk asset, its capital adequacy ratio is 20%, which indicates a strong financial position. Regulators review those reports regularly to ensure banks remain financially sound. Example, in India, the banking system is regulated by the Reserve Bank of India, which follows international Basel's third standards. These standards require banks to maintain minimum capital levels and proper risk management system to ensure stability. In United States, the Federal Reserve supervises banks and conducts stress tests to evaluate their ability to handle financial shocks. A recent example is the collapse of Silicon Valley Bank in 2023. The bank faced liquidity problem and poor risk management, which leads to its failure. This event highlighted the importance of strong regulatory oversight and proper risk governance. Advantages and limitations. Regulatory framework and risk governance provide several benefits. They help maintain trust in the financial system and protect depositors' money. They also reduce the chance of sudden bank failure and contribute to overall economic stability. Limitations. However, there are some challenges. Compliance with regulation can be costly and time-consuming for financial institutions. In some cases, strict regulations may limit innovation and slow down decision-making process. Therefore, regulators must balance safety and efficiency. In conclusion, regulatory framework and risk governance are essential for a proper functioning of the financial institutions. They ensure that risks are managed properly and the institutions operate with a full safety. Key points to remember is that strong regulation and effective risk governance help prevent financial crisis, protect investors, and maintain confidence in the financial system. This system play a critical role in ensuring long-term financial stability and economic growth.